Alrighty, so I am joined by Chris Cullen, Senior Vice President and Head of ETFs at Brompton, and today we're going to talk about BMAX, their Brompton's new all-in-one income solution. So Chris, thanks so much for joining me today. Welcome back to the channel.
And thank you so much.
First question is, how you been, man?
I've been pretty good. I've been good, Adrian. Not as good as you with your new tropical lifestyle, but
yeah,
I've been doing okay. Yeah, we've been a lot of my time in the last couple of months have been dedicated to getting this product up and running. BMAX Brompton Enhanced Multi-Asset Income ETF.
Yeah, so, really cool product. We'll talk about it today. So yes, I am in a tropical environment. Although you can't see it, I'm in my office. There's actually thunderstorms out today, but all is good here in Panama. So thanks again for joining me. So Chris, let's just get going right away. Tell me the premise behind BMAX. Tell me all about it, how you came up with it, and who it's, what kind of investor is it designed for?
Yeah, I mean, this product is really a diversified basket of basically all of our investment products. So it's got 70% holdings in our equity covered call ETFs. We have 7 of those, so it's 10% each weighting. The fund has a 20% holding in BPRF, which is our U.S. preferred share fund. So a bit of fixed income included in there as a diversifier. The other 10% is a bit unusual, but it's invested in our split share preferred shares. So when I say unusual, it's there's not very many investment products available other than the split shares themselves that can give investors some exposure to split share preferreds. But split share preferreds, both split share preferreds and U.S. preferreds, have had a lot more stability and better returns over the last decade than the Canadian preferred share market and then many fixed income asset classes. So yeah, we specialize in this area. We happen to. And we think that there's a lot of benefits in terms of diversification and income in including those in this product. And like other products of its type, this fund has I guess a lightly leveraged approach might be the way you could phrase it. It's not one of the double up, double down ETFs that are re-leveraged to 2 times leverage every day. Instead of 2 times leverage, the leverage is restricted to 1/3 of the net asset value. Mm-hmm. So it'll be good for boosting returns and boosting income. But it's not going to have the same kind of wild swings that you might expect from a double up or double down ETF.
Right.
So out of that area.
It's modest leverage. That's what's actually going to be my next question. So you guys decided on 33% leverage, whereas similar products in the market have 25% leverage. So how'd you come to that decision of having a little bit more?
Well, really the product can accommodate a little bit more leverage. Again, we don't want to get too much beyond, but the fact that we've introduced these preferred shares as fixed income diversifiers, it gives BMAX a bit more, I guess flexibility to take on a little more leverage and to boost up the income that's received in that product.
Yeah, it makes sense, right? The fixed income diversifier, which is 30%, a nice big chunk there, almost a third, is a much more stable asset class, right? Yeah. That's why it's multi-asset. Is actually in the name. So what would you say to investors who are kind of worried because obviously leverage is you're borrowing money to invest more or boost the yield? What would you say to investors who are a bit worried because they're seeing that interest rates are rising and obviously your leverage costs are rising? What would you say to them to appease their concerns?
Yeah, I mean, leverage costs are rising. Volatility is up in the markets, so that gives us an opportunity to write more covered calls, get more coverage on the portfolios and generate higher premiums to kind of partly offset that leverage. And the coupons paid, like the market rate of the coupons that are paid on our fixed income products have increased as well over this year. That's a kind of a fancy way of saying that fixed income asset classes have been under pressure too. And so yields have increased. So, while it's not ideal, if you're gonna borrow money to invest, it's better to do it at 0% than, currently the Canada overnight rate's about 3.25%. But it's still by historical standards a modest leverage environment, a modest interest rate environment. And as I said, the products that are the focus of BMAX also have increased their yields lately to kind of offset that cost of leverage. So I would say it's a bit of a wash in terms of that. So hopefully that answers.
Oh yeah, it does for sure. So one thing I noticed, and one thing that's really different between BMAX and the other 3 that are all in one, covered call income enhancing solutions, is that you have 30% in that fixed income, 20 of which is in your ETF that has the US preferred share. So my question to you is, why would you decide to put so much, or a good chunk in that fixed income, where we pretty much know that fixed income kind of underperforms equities over the long term? Like, why not just do it all with your covered call ETFs instead, for example?
Yeah. I mean, it's I guess it's all a matter of personal risk tolerance when you're looking at
Hmm.
these types of products. I mean, yeah, equities do outperform fixed income generally over the long term. I think like you see very long term rates of return for equities somewhere in the range of 6% to 8%, depending
Right.
on who you're asking this estimate from. And fixed income might be 5 to 6% over the very long term. But you got to take into account too that there are differences in volatility as well. So the returns are important and the risk is important as well. So we think that this is a pretty good blend in terms of high income, low volatility from the fixed income side, lower volatility from the cover call rating, as you talk about frequently. Cover call rating will lower the volatility of equities. So we just thought it was a good mix, and it offered something at a slightly different risk return point for investors that are looking for a high income solution like BMAX.
Makes sense to me, Chris. Makes sense to me. So now let's just quickly, and I know we had discussed it in our previous interview or Q&A. What's Brompton's approach to writing covered calls? As we know, there's two major factors: portfolio coverage and moneyness. Some fund managers take a systematic, set in stone approach. What about Brompton? How are you guys writing your calls?
Yeah. Well, we continue to take an active approach to call rating, which is to say that the PMs have discretion over the level of calls that they write in terms of how much of the equity portfolios are covered by short calls, and also in the moneyness, whether they're written at the money or slightly out of the money. That's really a decision that they reserve in their toolbox when they're looking at the portfolio and deciding how best to position it for the current environment. So they can choose to write a very high level of coverage. They could choose to write at the money or in the money, even if they thought that was a good way to perhaps liquidate securities, or they had a strong view that supported that. They could choose to write zero calls if they thought that the premiums that they received didn't overcome the attractiveness of the securities that they hold in the portfolio. That is to say, they have a strong view that the securities are going to have good capital appreciation, and best not to write calls in case that security gets called away. They can take all kinds of positions, and that's just based on their judgment and their work that they do on the fundamentals for the equities that they go out and buy.
Okay, so it's a dynamic approach where your PMs are always looking what's the best. I think that's a good approach, and knowing all these covered call ETFs by heart, I associate usually the Brompton ones with a good blend, a little bit more conservative with the call writing, but a good mix of both income and growth, because you want to capture a little bit of growth as well. So I think that's a good strategy, especially when the market conditions change. You want to be able to change with it. So I think that's a good idea.
Great.
So next
We do
couple of
too.
questions. Sorry, go ahead.
I said we do too. We agree.
Okay,
That's
good,
fantastic.
good. Glad to hear it. So next couple of questions are more generalized questions. I mean, we could talk about BMAX more, but I mean it's a pretty straightforward product. It's really a blend of all 7 of your covered call ETFs. 10%. You got healthcare. You got technology. What I like is that you guys also have a Europe one, a global one in there. So really beautiful diversification, if you don't mind me saying.
Great. Thank you.
As well as your split funds, you got that GDV, which I really, really like. So now there's kind of an alternative. If you really don't want the split share fund, you could always get BMAX. So I always have to commend Brompton on their stock selection. I find there a little bit some stocks that you don't see in other portfolios. I always love that diversification.
Yeah, no, that's great. I mean, for Europe, we're all aware of all the issues that are going on there,
Right.
and there is a lot of, I would say, fear baked into stock prices right now. But we're seeing historically low valuations in Europe compared to past periods, very long periods of time. We haven't seen Europe at this low level of relative valuation to U.S. stocks. Europe is usually on a price to earnings basis 2 to 3 points lower than the U.S. But we've gone like beyond the 2 standard deviation level of low valuations in Europe. So it's despite the the uncertainty creates opportunities. And
That's
so we
it.
think that there
Exactly.
is a benefit to having a small exposure in BMAX to Europe. I think that a year to 2 years down the road that we'd all be pretty glad that we had that.
Yeah, and it is only 10% of BMAX, right? It's only 10%, and that 10% is really, it's not like they're small cap stocks. These are the big blue chips in Europe,
Yeah,
right? Nestle and
yeah, Adidas
AstraZeneca.
and
Yeah, all the
LVMH,
ones
like
you
those
really
names.
want, right? Louis Vuitton, right?
Hmm.
The big guys, right? So I always like that. I think it's a good idea. It's a good way for, typically North American, Canadian investors, we're going to focus a lot on Canada and the US, but Europe has some decent stuff as well. And like you said, it's not the first fund manager that's telling me this, that they're at really cheap valuation.
Yeah,
So I think that's a great diversifier.
that's great. Yeah, the European market in more normal times, it has a lot of multinational companies. I mean, the Europe itself is a conglomerate of different companies or different countries, sorry.
Right.
And all the operators in those areas, if they want to grow, they have to learn how to navigate across borders. And so that you can think of that as really part of their expertise. So what you get in a lot of European countries, European companies, I'm messing that up. What you get in a lot of European companies is very good geographic diversification of revenues. And so if there's a problem going on in Europe, LVMH actually has a significant portion of revenues coming from Asia. And so you've kind of diversified away some of your exposure to that kind of political situation. So yeah, lots of interesting companies to buy, lots of large cap multinational names in Europe.
Yeah, that's what I like. The big cap blue chip guys, that are always going to be around for the next 10, 100 years, whatever it is. So that's the way I like to invest in more conservative stocks. So that's great. Just next couple of questions are just some more broad questions about covered calls in general that I think are good questions. I keep getting them and I sometimes have a hard time to answer it. So first one is, who actually buys call options?
Yeah.
Right, so your covered call ETF is selling, whereas we're writing call options on the stocks every single month or whatever it is, every 2 months. So who's actually buying these calls?
Well, I mean, there are some natural buyers. Like, I mean, we saw in the last, I think it was in 2021, SoftBank came out and just revealed like a huge long call option book that they were using to build up positions so that they could take over technology companies and buy them out. So that would be really an exception. I think that there may be some retail investors, quite a lot of them that take small positions. Those guys would be one of the biggest buyers, that non-core buyers really, that I would see. But I would say non-core because the majority of the buying of options that are sold by covered call funds are simply the securities dealers that make market in those options.
Interesting.
RBC, for example, has a great big book. It's one of the most internationally diversified financial services companies that come out of Canada. So they've got all kinds of positions with all kinds of clients around the world. And one of our funds, or any Canadian fund that's selling covered calls, they have so many diverse positions, long and short, in their book of business, that they can fit some long call options in no problem. And it actually, for the most part, would likely help to diversify and bring down their overall risk. So they're managing their risk book from a holistic point of view. And if a few more covered call options come in out of Toronto from Brompton funds, well, that might cover some short positions that they have with an international client in some stocks too, and kind of match out and eliminate some risk for them. So that would be the idea behind it. I'm not a derivatives trader or a risk manager at one of these big capital markets desks, but for laymen like you and me, I think that's a good way to look at it. That they have such large and diverse exposures that buying call options actually gives them some diversification in their risk.
Oh, that's perfect. I really appreciate that. I had no idea really the extent of how popular and how big this market is, but it's not just a retail investor, right? Like you said, it's mostly these big institutions. And one thing I remind people is that you're buying call options not necessarily only because you think the stock is going to go up, but you're also buying it to hedge a short position, like you said. So this is a lot of these institutions, hedge funds, buy these call options to hedge short positions as well, right? So like you mentioned. So yeah, very interesting stuff. What about during a bear market? Is there still the same type of market or the same type of action, you would say, on buying these call options? I kind of like to say it's like an infinite source of income. We had discussed it in previous, but is there any difference like when there's a bear market now versus a bull market in terms of the market for the calls?
There is, in that in a bear market, volatility tends to spike. In a bull market, after a while, when stocks just keep going up and everybody's comfortable and people start to get a little bit, in a tizzy, I guess, of future returns and getting excited about the markets, markets tend to go in one direction for a long time. And that would indicate low volatility. When stocks are in bear markets, there's a lot of uncertainty, and they're buying one day and they're selling the next day, and stocks are up and down, and that creates obviously that is the reflection of volatility. And when markets are volatile, call premiums get bigger, because that's just part of pricing a call option. If I'm going to buy a call on a certain stock and it's a more volatile stock, then that means it has a better chance of finishing in the money, and my call position is going to be worth something at the end of the term. So yeah, in bear markets, you tend to see higher volatility. You tend to see richer call premiums. You still tend to see the demand, the liquidity for call options. I mean, depending on what day, depending on how hard the market's selling off, or how hard it's rallying, and how much things are in flux. Of course, there's a lot of caveats there, but typically you would continue to see buyers in the market, and you would see higher premiums under those types of market conditions.
Makes perfect sense. And one thing I really, and going back to BMAX now, I forgot to talk to you about it because the management fee is zero, because these are all Brompton products inside of it. So the underlying management fee is zero. But of course, there would be an MER would include the leverage expenses as well. So I know you probably don't have the exact number, but you have an estimate on maybe how much the MER would be on BMAX?
Well, yeah, the MER prior to the cost of leverage is going to be about 1.3, and that would include the MER of all the funds that it holds. Right, as you noted, BMAX itself has no management fee, but all of the funds in the portfolio, for the most part, and I'll give you the exception in a minute, but for the most part, all the funds in the portfolio have a management fee, and they have a general and administrative cost. Add those two things together, that's how you get their MER. So when BMAX holds those funds, they have to report as part of the MER of all their holdings. The exception that I mentioned a minute ago were the split preferred share funds.
And splits,
just due to the way that accounting for preferred shares work, they don't really have a NAV, and they don't really have a management fee that's being charged directly against them. So, for that 10%, there really is a zero management fee for BMAX. But for the rest of it, all the underlying funds do have a management fee. We're just not charging an additional one at the BMAX level. So that's how that works out. So there's no additional costs to buy BMAX in terms of management fee over and above the management fee charged in the underlying holdings.
Perfect. That's good. Last question, more of an overall question. What happens when a call is exercised? So let's say for any Brompton covered call ETF, you're selling an out of the money call or an at the money call, whatever it is. What actually happens if the strike price reaches the target and the call actually gets exercised? What happens?
I mean, if it gets exercised, then what you would expect would happen is that the fund would get notice of exercise, and T+2 settlement. The fund would no longer hold the stock subject to call exercise, and it would be gone. So that's pretty much it. And the strike price would be paid for that holding. So if it was a $50 stock when a call was written and it went to 55, that's it. It's gone, and I got $50 for it. And to buy it back, I have to pay 55 in the market. So I hope I got a good call premium for selling that call.
So do you guys buy back the stock right away, or do you wait till you?
I guess it would depend on the PM's views of what's happening exactly on that particular day. But yeah, the idea would be that they would buy back. Now I'll say that it's not as common for options to be exercised before the final day of trading. They would usually be exercised at the close. And if it turns out that we're getting up to the term, like the end of term for options that happen to be in the money, the PMs may decide to go to the market and buy back those short positions and cover their positions, and then not have the stock exercised. There's tax reasons to do that, because if you get a stock exercise and it has some embedded capital gains, even if the scenario that I mentioned before, where I got $50 for my $55 market value stock, maybe I bought that stock for $20, so I got a $30 capital gain. We want to avoid triggering capital gains unnecessarily. So in the case where there is an in the money call position that looks like we're going to get called away on some stock positions, the PMs would likely make the choice to go back into the market and see about buying that back to close the position out.
Interesting. So tax considerations to make the fund more tax efficient is also something your PMs consider, which I like hearing as a retail investor, because you always want the most tax efficient income. And I'm assuming that this is where that's why there's always a ROC component usually to a covered call ETF, right? It's not necessarily, a lot of people have negative connotations on ROC, and I'm always trying to show that, it's just a tax source, like it's nothing to. So would that be the case? Would you agree with that?
Well, I mean, ROC is generally a distribution that we'd make that has no allocation of any kind of taxable income to it, right? So ROC can be created in a number of ways. One of the implications of our active cover call program is that from time to time they will pay ROC, because really, like, okay, let me just, I won't go dive too deeply into it, but really what we're doing when we're writing calls is we're saying, if you give me this premium for the call I'm going to write, yeah, sure, as of today, I will sell you this stock at the strike price, right? So what we are trying to do is say, we're making a judgment call that the premiums received for the calls that our fund managers are selling are probably richer than our estimate of what they should be worth. We're selling this call not because we want to get exercised, but because we think that to a large degree we'll be able to take the premium and not get exercised, and then we'll be up right over where we would have been otherwise. So we are making kind of like we are making buy and sell decisions indirectly whenever our PMs decide or do not decide to sell cover calls. So these are all capital transactions, buy and sell decisions. So if our PMs decide, no, I'm not selling the calls because I think that the stocks are going to go up and I don't think I'm getting enough premium on the calls, on the other hand, then we'll still pay the distribution. It just won't be funded by cover calls. So there may be that we sell some stock positions and we pay out a distribution. If we're in the kind of market we're at now and call premiums are very rich, then the PMs may have more opportunities to generate capital gains by selling cover calls, not getting exercised, not having to buy back in the market. And then we'll have more taxable income to flow out to investors at the end of the year. But you can see, like, if we're giving them full discretion and we're going to keep paying the distribution, then sometimes we just have to say, look, this was the better way to go, to not write calls. So we're going to trim a little bit of the portfolio and pay it out to investors to kind of keep the distribution going. That creates ROC sometime. And sometimes, as you noted, right, like if we have to close out a call position at the end of the month, then that would also create ROC, because there would be some offsetting expenses that would eliminate some of the capital gains we realized at the time that we sold that call. So lots of different reasons for it. I hope that wasn't too in-depth of an explanation.
No, I mean, I understood it. I mean, I know that selling, that whole process is complicated, and this is why I'm such a big proponent of let the professionals manage it. You pay that small management fee, which is always less than 1% anyway. And you make sure you get that perfect balance, or you don't get into trouble doing it yourself, just like trading stocks by yourself. So I think that makes complete sense. So that's it for the questions. I mean, I want to thank you again, Chris. I really love BMAX. It's now a fourth all-in-one income solution. I'm sure it's going to be extremely popular with my audience, and I'm going to be talking about it all the time and definitely investing in it personally. So thanks again for creating this cool solution, and come back anytime.
Really appreciate you having me on, Adrian, and look for our listing this Thursday, October the 20th, BMAX on the TSX.
I'm sure this video would be out by then, but for everyone watching, it should be out October 20th, and the stock symbol is BMAX on the Toronto Stock Exchange, of course. Is there a US currency version, like a BMAX.U yet, or right now you just have a BMAX?
We're going to wait and see, and if we get some inbound demand, then we would make that decision at a later date.
Sounds good. Thanks again, Chris. Take care, buddy.
Okay, thank you, Adrian.
Bye-bye. Thank you so much for watching, everyone. I really appreciate it. Don't forget to hit that thumbs up button, that like button, and make sure you're subscribed not to miss out on my future content. Of course, hit that little bell next to the subscribe button so you're notified for any new content that comes out. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once, which is awesome. So this is a companion tool. It's a reference tool that will help you build your own portfolio according to your needs and goals, and it covers both the Canadian and American and US stock markets. So make sure to check it out. I have a video explaining from A to Z exactly what the product is. I showcase it, so there's no surprises. If you're interested, make sure to check out that video. Also, right there on my website on the homepage, I do offer a one-on-one coaching session with me. So this is a 1-hour Zoom call with yours truly for in case you need personalized help. I'll answer all your questions and I'll help you best I can. Just remember, I'm not a licensed financial planner or financial advisor. These are just going to be friendly conversation, right? It's just going to be my opinions. But if ever you're looking for that personalized touch, that personalized help, you could book a one-on-one with me. Make sure to check out the message on top of that calendar. That will give you a status of my bookings for that month. Also, we do have a Facebook group, great Facebook group, over 12,000 members. So make sure to join our community. The group is called Passive Income Investing, a nice Facebook group where everyone is sharing their thoughts and opinions and sharing their experiences. So it's a really nice group. We make sure to stay on top of the scam and the spams, and we delete those right away. So make sure to join our Facebook group. If ever you want something more personalized with us, you could follow us on Instagram. That's where we post more personal things on our adventures here in Panama. So follow us on Instagram if you want. And how do I always leave you? Continue to stay safe, continue to stay healthy, and of course, stay passive. See you next time.